The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Political tensions rise, risk appetite wanes, and the AI trade gets squeezed in between. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. We have a sell-off on our hands. The S&P 500 pretty dang close to session lows right now. We had CPI this morning coming in as expected, still pretty hot compared to recent history, but as expected. But it's really the back and forth between the U.S. and Iran that seems to be at the center of the market mind right now as we count down to Oracle earnings, which might explain some of the jitters in the NASDAQ 100 right now. But take a look at what Brent is doing, starting to see some signs of life there. We've been talking about how energy hasn't been quite reacting to the back and forth, but you can see Brent higher by about 2% right now. Treasury yields also moving a little bit higher on the heels of that CPI print. The 10-year Treasury yield higher by about 2 basis points, Romaine.
Looking at the red on the screen, Katie, risk appetite was already strained before today, but that CPI report this morning gave markets a bit of agita, and not just because of that headline number. It was high, a 4.2%, the highest annual rate since 2023. But the report, it also suggested consumers are pulling back on non-essential spending. And then you had a separate report that combines the inflation figures with wage data, and that showed real average hourly earnings dropping the most in more than 3 years.
I think essentially we're going to get a 12-0 vote to do nothing. The safest thing the Federal Reserve can do politically and also economically, I think, is just to do nothing here. Inflation is higher than they want, but I think there's a good chance that this month, May, will actually turn out to be the high watermark for inflation in this cycle.
High watermark? Well, we hope so. A sharp reminder, though, just 3 hours ago, that the instability of U.S. foreign policy, well, remains unstable. The president today vacillating back to threats of intensified attacks on Iran. After all, remember, it is the Iran war that kicked off at the end of February, and the resulting surge in gas prices that is largely responsible for the headline inflation rate almost doubling in just 3 months. Now, the aggressive rhetoric from the White House, it comes at a precipitous time for equity markets, which are already under pressure from the shifting sentiment around that market-leading heavyweight tech names. That sentiment to be put to the test again in just about 1 hour with earnings from Oracle, which, for better or worse, Katie, will serve as a referendum on the AI infrastructure trade.
Absolutely. Those earnings going to land at a very interesting time when it comes to AI sentiment. But as we've been talking about on the show over the past couple of days, you've seen breadth come back into this market, and that's neatly illustrated by the chart behind me. In blue here, you have the percent of members in the S&P 500 above their 200-day moving average. In white here, you have the S&P 500 itself. And you can see that breadth really took a hit when it comes to the kickoff of that war, really coming down. But now you can see about 61% of members of the S&P 500 are trading above their 200-day moving average. And while that's not exactly the highs that we've seen over the past year, think about where we were again when it comes to March, April. Think about where we were about a year ago right now. And what's interesting, if you zoom in there, you can see that as the index has moved down, as we've seen these tech jitters really come to the surface and manifest in a sell-off, you can see that breadth has actually improved in other parts of the market, Romaine. So there's still pockets of resilience to be found out there, even as we start to see some of this tech trade start to wobble.
And as we kick you off to the close here on this Wednesday afternoon, we want to bring Anushka Gupta into the conversation, head of Americas at Goldman Sachs Apex. Anushka, great to have you here.
Thanks for having me.
Look, I know you said in probably a more favorable purchase, you don't have to get too obsessed about some of these day-to-day moves, and you focus a little bit more on the long term. But I do want to start off with the short term, primarily because it does seem like it is having an impact on at least the long-term thesis, whether it's the AI trade or really just the direction of inflation and interest rates. And I am curious as to how you sort of make what you make of the developments over the last few weeks.
Absolutely. Thanks again for having me. You know, it's been a volatile period, not too surprising from what the rest of the year has been, honestly. And like you mentioned, family offices have a long-term horizon. They withstand this volatility and, if anything, use periods of immense dislocation to step in and be opportunistic. From an overall S&P and equity market standpoint, we remain pretty constructive. And like you mentioned, a lot of that's underpinned by earnings growth, which we've seen accelerate quite significantly, 24% growth for this year, 13% for next year. And relating to the macro picture broadly, the inflation report was largely in line with expectations. The payrolls report was encouraging. And so investors continue to spend time on that short term, but they're not making meaningful portfolio shifts as a result of it.
You have confidence that the earnings picture will hold up. I mean, we just had two earnings seasons, that fourth quarter and the first quarter. Both were well above expectations. And it seems the consensus is that by the time we get to the end of the year, those final numbers that we see for the S&P in aggregate are going to be higher than what most people predicted coming into this year.
That's exactly right. We're very constructive on the earnings cycle, and we see that, payback from some of the capex spending starting to flow through. So it's something we're excited about. And do think this year the level of growth we've seen from an earnings perspective, especially in the first quarter, is pretty phenomenal.
Well, when you think about, what we're seeing in terms of earnings growth, which has really been underpinning a lot of the bullish sentiment up until this point, you point out in your notes that you think about the percent of EPS growth that has been concentrated among the beneficiaries of AI infrastructure investment that's around 50% today. So you think about this broadening that we've been talking about, the resiliency of other sectors outside of AI, given that, a lot of the earnings picture and the optimism and improvement that we're seeing there does tie back to AI. What does that portend for, this improving breadth that we've seen? Can that continue?
Yeah, we think it can continue. Look, the S&P is a market-weighted index, and we've seen that concentration with the top 10 stocks comprising nearly 40% of the index for a reason. And that concentration is a result of the benefit we've seen from an earnings perspective. A lot of that growth in terms of what we're recommending clients, invest in is in the AI infrastructure segment of the market where you've seen the most return from an earnings perspective. But we think it's important to be diversified. Some of the other sectors we've seen clients spend time on. One is healthcare, which is a direct beneficiary of some of the segments, through AI that are driving costs down and increasing efficiency from a data perspective. And also on the bank stocks, just as a way to play the capital market cycle. Mm-hmm.
Well, let's talk a little bit about public versus private right now, because as Romain alluded to, you work heavily with family offices. And I wonder, what the mood music is, what the appetite looks like when you think about what we're seeing in public equity markets versus the private markets, and the fact that, some of the most exciting private companies are starting to come public. How is that, changing your conversations right now?
It's a great question. And, we hosted our annual Global Family Office Symposium last week. We convened 200 family offices from 19 different countries around the world. And AI was really a pervasive theme in that discussion. We surveyed clients who attended, and over 80% of them said that they're adding exposure to AI across the public markets, private markets, or in specific single company exposure levered to that theme. We also heard from clients that, late stage exposure, whether it's venture or growth related, remains a dominant theme. And that's largely because the scale and velocity of innovation and what that's translating to in terms of revenue growth in the private ecosystem is quite significant. But holistically, family offices are more overweight alternative assets than, a typical high net worth client. That number is give or take 43, 44%, depending on the year. Yeah. So we do see that bias play into portfolios. Are
they still overweight U.S. assets, or are we seeing them maybe a little bit more exposure overseas?
We're definitely seeing U.S. overweight across both the private markets and the public markets. The focus remains, from our perspective, on constructing globally diversified portfolios, but with a U.S. preeminence view. And given what we've seen in the semiconductor stocks and the opportunities in emerging markets in particular, we have favored exposure to some emerging markets funded out of developed international markets.
Anushka, great to have you.
Thanks so much.
Anushka Gupta, their head of Americas over at Apex at Goldman Sachs, kicking us off to the close here on this Wednesday afternoon. Fresh off that hot CPI print, you have a bond market telling Kevin Warsh the rates should be higher. But that CPI print, believe it or not, it might actually suggest he has some wiggle room to move rates lower. Our conversation up ahead with former Fed Governor Betsy Duke.
And from hot inflation to an even hotter IPO pipeline, look at what to expect from the long-anticipated SpaceX IPO and how it will shape the entire IPO and M&A market with Eddie Best. He is the co-chair of the capital markets practice over at Willkie, Farr, and Gallagher.
And we're going to talk Madonna, Shakira, Chris Martin. They're not going to be here, but we got the next best thing. The CEO of Global Citizen, the company producing the first ever FIFA halftime show. lot to talk about here on The Close. Stick with us. We'll be back in a moment. This is Bloomberg.
Well, oil prices slightly rising here, higher by about 2% as President Donald Trump escalates his threats toward Iran, saying that he will, quote, hit Iran hard after posting on X about delayed peace talks. Joining us live to discuss, I'm pleased to say, is retired U.S. Army Brigadier General Mark Kimmitt, also the former Assistant Secretary of State for Political Military Affairs. He also served as Deputy Assistant Secretary of Defense for Middle East Affairs. So quite a tenure there. General, pleased to have you with us. Let's talk a little bit about the change in tone that we've seen from the President of the United States just over the past 24 to 48 hours, bringing us to today, of course, with, again, that threat that I read out that, you know, the president vowing to hit Iran hard. I wonder what you make of that change in posture, because up until this point, up until, you know, this week, really, we had been mostly talking about the ceasefire and the possibility of extending it.
Yeah, I think the joke going around Washington, D.C. is we've been encountering a peace fire. But look, the fact remains is I think the president has found out, as he continues to say 2 or 3 days away from an agreement, he's probably found out that the Iranians are backing off or are unserious about truly getting back to negotiations. And it doesn't surprise me at all, because I've never really felt that the Iranians were serious about reducing or eliminating their nuclear program.
And I do wonder, you know, what you make of what has been a big point of leverage when it comes to the Iranians, and that is the Strait of Hormuz, because we also heard from President Trump today posting that the U.S. military has supported the passage of more than 200 commercial ships through the key waterway, resulting in more than 100 million barrels of oil making it to market. And certainly we've been tracking the movement in oil. We're still below $100 per barrel on Brent. And, you know, if we are actually seeing flows move through the strait, I mean, where does that leave Iran in terms of having any leverage?
Well, I think we really need to understand on these separate issues. Is the Strait of Hormuz a core issue? Is Lebanon a core issue? Or, in fact, are these diversions? Because the war was started for 3 reasons. Because of the Iranian nuclear program, their missile program, and their proxy program. But once the war started, I think the Iranians were quite clever in turning the focus onto the Strait of Hormuz. Now, as you say, there looks to be some leakage there in the eyes of the Iranians. And so what have they done? They've now diverted to the issue of Lebanon, trying to couple the Israeli-Lebanon war with the negotiations. So again, to me, I think what we're seeing is a pattern of delaying, denying, diverting. To me, there is no logical reason for the Iranians to not want a nuclear program, except to relieve themselves of war and sanctions. But they've demonstrated they're pretty flexible and they're pretty durable as well. So I don't see the strait, nor do I see Lebanon as core issues, but I see them as diversions on the part of the Iranians.
And we've already heard earlier today from the Iran Foreign Ministry claiming that basically a lot to go on. We've heard from the Israeli defense minister saying that the war is far from over. I do want to bring your attention to some comments that Nikki Haley made on Bloomberg earlier today, the former UN ambassador. Basically, in her view, that she says that Iran never really wanted any sort of a deal, and she's urging the president to, I guess, finish the war, in her words. And I am curious as to what finishing the war would even look like, given what we know about the landscape of the Iranian regime.
Well, I agree with Nikki on the first point, that they never really have been serious about negotiating. I don't agree on the second point. It needs to be more than military. Military success alone, however we describe it, will not lead to strategic success. We are trying to use all elements of national power: diplomacy, information, economics, and military power. But as we found out, Iran is a tough nut to crack. I don't think that military success will be tantamount to victory unless we go significantly more and higher pressure, and possibly going after infrastructure targets that we otherwise would not go for, civilian in particular.
Well, give me a sense here for a layperson, when we start to talk about, what the military's role in all this, when we've been in the conflicts in the past, particularly in some of the campaigns that you've either been involved with or been advising on, what was sort of the symbiosis between the military leaders and, let's just say, the diplomats and that side of the administration? Did they work closely together towards whatever the end goal was?
Well, it certainly was the case in Iraq and Afghanistan that we had very, very large State Department elements working side by side with the military forces. I think in Iraq, Afghanistan, that really brought around this notion of having State Department military integrated all the way down into, we had provincial reconstruction teams in Iraq that had a military leader alongside a State Department leader. So that's important, but as we've seen in these really tough cases like Iran and unfortunately Afghanistan, that's not enough to bring about behavior change on the part of the enemy. And that's really what this is all about. What do we have to do to change the thinking and the behavior, in this case, of the Iranian regime?
All right, General, really appreciate you taking time for us, as always. Retired U.S. Army Brigadier General Mark Kimmitt. All right, we continue to count you down to the closing bells, and we are going to turn back to the markets themselves. They are down on the day. This after a gauge of consumer pressures continued to rise. We're going to get a read here on what's been actually going on in the retail segment. We're going to catch up with Dana Telsey over at Telsey Advisory Group when we come back after the break. This is Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off with Illumina. JP Morgan upgrading the gene sequencing stock to overweight. The price target goes to a street high, 185. JP Morgan saying it's more comfortable with the company's customer stickiness. Those shares now on a 2-day run. Next up, Invent. Bernstein initiating coverage with an outperform as part of a broader call on 11 multi-industrials. Now, Invent, it's a data center power and cooling firm. That price target is getting set at 218, which is basically a street high, and the analysts citing the company's technical moat. Nevertheless, the share's down for a second day. And finally, let's talk about Nike. RBC downgrading to sector perform. The price target goes all the way down to 50 from 70. The firm citing a slower than expected turnaround under CEO Elliott Hill and lukewarm customer reception to some of its new products. Those shares down 1% on the day and about 44% from its 52-week high. We do want to say in the retail space right now, on the back of the hottest inflation print in about 3 years, and whether that's putting pressure on Americans' paychecks and, more importantly, their willingness to spend. Joining us right now is Dana Telsey, CEO and Chief Research Officer at Telsey Advisory Group. Before we talk about today's CPI print, I just want to go back in time and just look at the last quarter, because there were a lot of people thought we were going to see some bad earnings out of the retail and apparel companies, primarily because of the elevation in gas prices. Most of the companies seem to defy that. One particular stood out to me, and that was Ralph Lauren. And I know that's a higher-end consumer, but their numbers were bonkers. And more importantly, the executives on the conference call, they seemed incredibly bullish about the rest of the year.
Exactly. One of the things you see, first of all, thank you for having me.
Yeah, sure.
One of the things you see with Ralph Lauren is they're having a wider appeal, both younger consumers and older consumers. Look what they're doing with the sponsoring of sporting events, whether it's a Wimbledon or Olympics. And so the reach is much broader. And with that, the quality of the products improved, the stores have improved, they're getting traffic, and you have global improvement too with Ralph also. So it's exciting.
It's mainly a higher end consumer. Let's go down to the other end of the spectrum, and that's Ross Stores, which also surprised a lot of folks to the upside.
The number 17% was the comp for Ralph, but you know what? 17% was the comp store sales increase for Ross Stores too. With the transformation of increased marketing, improving their stores, I think now you're going to see more Ross stores on the East Coast also. There really is a long runway for Ross to continue to show continued growth.
Continue to show continued growth. And I wonder, when we're talking about stores such as Ross, what there is to extrapolate about the broader economy. That's what we do here on Bloomberg Television. I mean, are we seeing anything specific that suggests to you that there is a trade down going on right now?
I think you're seeing that. I think look at the brands available in Ross, TJX, or Burlington. You're getting better brands. You're seeing a trade down. You're seeing it in Walmart also. And you're seeing that the brands available in these off-pricers whether it's in home categories, whether it's in apparel categories. It's a wide assortment of goods that is available there, and they're getting traffic. It doesn't hurt that they're also each opening a lot of stores so you can find them in more locations.
And what does that mean for the brands, the stores that are being traded down from? Are you seeing them offer discounts in response? What does that sort of fight back look like?
So one of the things you're seeing is more newness and innovation is driving full price sales. So some of these brands, if they're offering new things, innovative things that you haven't seen before, it's also helping their stores. And you're seeing that, for example, like in a Victoria's Secret, where you've seen low double-digit increases in some of their core categories, and you haven't seen low double-digit increases from them. So the focus on new, the focus on innovation is driving newer customers, yet the focus on value remains very relevant for off-pricers, and you're getting that customer too. For the whole, even in the face of the Middle East conflict, rising gas prices, inflationary headwinds, the consumer still is spending. And let's not forget, coming up, whether it's the basketball game tonight with the NBA Finals, whether it's America's 250 in New York City, we're going to have fireworks from Macy's on both the west side and the east side. Whether it's the World Cup, you're giving consumers experiences, and when they have experiences, they typically buy things, and that's helping.
I am curious, though. Do you not worry at all? I know that, we talk about this sort of transitory nature of these increasing gas prices, but it's been persistent, and based on whatever headlines we got today, it's likely to be persistent for some time. Does that factor into your outlook for the rest of the year? Do you anticipate we could see a pullback maybe in some of the discretionary spend?
We watch it very carefully. Keep in mind that one of the things we wonder about is everyone benefited, or a lot of people benefited from tax refunds. As those roll off, are we going to see slowing sales? Yet data points that we're getting, we're continuing to hear on a weekly basis, wait, we're holding up. We're seeing more increased order trends. In the back half of the year, will public companies have the benefit, and we don't know when, what tariff refunds being added back in. But with earnings guidance being reaffirmed for the year and potentially the benefit of tariff refunds, for the first time in a long time, we could see discretionary perform well in the back half of 2026.
All right.
All right. We're gonna hold you to that and have you back, Dana.
Fingers crossed.
Are we going to see you courtside tonight?
No, I won't be courtside. Are we going to see you courtside?
No.
What about you?
Apparently Taylor Swift is going to be there. I will not, though.
Wow.
But
we'll be watching.
There you go, Dana. Always great to see you,
Thank
especially
you.
in studio. That is Dana Telsey. She is CEO and Chief Research Officer over at the Telsey Advisory Group. Now, coming up, former Fed Governor Betsy Duke joins us live to react to that hot inflation print and tell us how the central bank could respond in its new era under Kevin Warsh. When we return, this is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on these equity markets. Of course, Romaine, watching a deepening slump when it comes to markets overall, but especially in those big tech names.
Absolutely. Now hitting session lows for most of the major indices. And just a reminder for our audience, we're going to get another test of that tech trade after the bell when we get earnings report out of Oracle after the bell. But of course, a lot of the softness that we're seeing in the market today, partly because of the increased rhetoric from the White House towards Iran, but also that CPI report that we got this morning, which certainly in line with expectations, but those expectations were relatively dour.
Yeah, absolutely. Yeah. Coming in on the screws. But again, you compare that to recent history and certainly paints a picture of inflationary pressures reasserting themselves in this economy. So let's get to it with former Fed Governor Betsy Duke, also the former chair of Wells Fargo. Betsy, fantastic to have you with us as always. So as we were discussing, you think about the figures that we got this morning on the headline, on the core, coming in pretty much as expected here. But how does this change the needle, move the needle, if at all, when it comes to the debate over what the Federal Reserve is going to do when it comes to its interest rate trajectory and what we hear from Kevin Warsh, the new Fed chair, in about 7 days' time?
So for the committee overall, I'm not sure it changes anybody's mind as far as something to do immediately. So I still don't expect any action at the next meeting, but it's disturbing. And, you know, the economists can parse inflation readings and talk about this and trim mean and all of the different measurements of inflation and what's going. But for everyday consumers, that doesn't matter. The things you have to buy are getting more and more expensive. And now for the last 2 months, the expenses are outweighing paychecks. And that's where the real danger is.
Yeah, and I want to continue down that path because, again, you think about what we saw on headline inflation. It was really driven by higher gasoline and energy prices. Of course, you wouldn't see that in core, but you make the good point that it still affects human psychology when you're paying more for those higher energy prices. How does that typically translate through into how consumers spend their money? Because sentiment has been pretty low for a while here, but we haven't necessarily seen that direct line yet.
So it's not just how they spend their money. A lot of the issues come with what do they do in terms of expectations? What demands do they make in terms of wages? So the most important thing to control inflation is the credibility that the Fed can control inflation, or credibility that the government can somehow control inflation. And once that credibility is lost, then everyday consumers are just scrambling to make enough money to be able to pay for things that they're quite certain are going to cost more and more and more in the future.
This raises the question, and it might be a dumb question. I think I know the answer, but who is Kevin Warsh speaking to when he takes that podium? I mean, is it the markets, which I presume it probably is, or is it those everyday consumers that you're kind of referencing? Because there is a disconnect here that the markets are looking at today's report, and they're seeing a lot of upside potentially for what would lead to rate cuts. But then again, the anecdotal evidence on the ground, when you talk about falling saving rates, rising debt levels, collapsing consumer confidence, shows that people on the ground are struggling.
Well, when the chairman takes the podium, he's speaking to markets, to investors, to consumers, to the public at large. But for Kevin, this is going to be his very first statement to all of those publics. And so I would look for him to sort of set the stage for how he thinks in the future. And I don't think you will see it as specific as, this is how I would react to that, and a very specific reaction function. But I think overall, Kevin is going to remain a hawk. Kevin's going to be concerned about inflation, concerned about getting inflation under control, but he's going to tackle it perhaps in a different way than previous chairmen have.
When we talk about the report that we got today, and particularly some of the disinflationary components that we saw today, I think it was cars, household furnishings, it seems like some of the interpretation, at least by Bloomberg economists, is this idea that that is a reflection that the consumer is pulling back on that rather than this being some sort of structural shift down in those prices.
Well, I think we've had so many one-off issues. So you go all the way back. There were the supply shocks of the economy reopening after COVID. Then you had tariffs. Then you had the war. You had gas prices. And it's very hard to know how all of these are feeding through. But it's very important that prices have now been below the Fed's target for 5 years, possibly even more by now. When I was at the Fed for 5 years, and in that time, we could never get inflation up above 1%. So you have to begin to question whether the Fed has the will to control inflation or the ability.
Yeah, the ability is certainly an urgent question here. And, I was reading some reaction from our colleagues over at Bloomberg Economics, and they do think that there could be this sort of self-correcting mechanism when it comes to inflation, sort of what we were talking about with, consumer psychology, that, if we see the cost of living rise to a certain point, that's going to bring down discretionary spending in other parts of the economy, and eventually lower prices. And, I wonder if that's a theory that you agree with, and, how much water you would put in it at this moment.
So there is some truth to that. The part I'm not sure of is when you get this K-shaped economy, or the difference between consumers who are struggling day to day and particularly investors who have seen tremendous gains in the market. And so they're the ones doing most of the spending now. So how does their spending adjust versus those who can barely pay for the things that are non-discretionary?
When we talk about, I guess, how you right this ship, there has been some discussion that a monetary policy alone, or at least the interest rate function of monetary policy alone, won't be enough to really turn that tide. How much power does a shift in interest rates, either up or down at this stage, actually have?
I'm not sure it's going to have a big difference, whether it goes a quarter point up or a quarter point down. I'm not sure that's going to make a big difference, which is why I think the Fed is perfectly right to hold steady until they begin to see, are some of these issues going to play themselves out and begin to return to the norm, or is there something that's running away from them? So I think waiting until they establish a direction is really the thing to do.
And it seems like in the markets, what's being priced in outside of what we're seeing in AI, of course, that's its own special situation, is a quick end to the conflict, some sort of resolution that's tangibly in the offing. That's explained what we're seeing when it comes to breadth in the equity market, what we're seeing, the sort of non-reaction that we've seen in the energy markets. But Betsy, I do wonder, how much damage has been done when you think about what we've been seeing in the rising prices of energy, of foods, grocery bills, et cetera. I mean, even if we saw an end to the conflict in somewhat short order, a reasonable manner, I mean, how much of what we're talking about, these inflationary pressures, are becoming entrenched here?
Well, I think if you saw an end to the conflict, you would definitely see some reduction in inflation. Certainly, fuel prices would come down, and any way that they're feeding through to other inflation would begin to come down. So I think that's the case. The other issue at play that I'm not sure of is the size of our federal debt. The other news that didn't get a lot of play today is the fact that Social Security is going to run out of money a little bit before than they originally thought. So senators running for the Senate right now will have to deal with this issue of what to do about Social Security in their 6-year term. That's a very short window, and the higher the debt gets, the more that's going to push rates up, regardless of what the Fed does.
All right, Betsy, always appreciate it. Former Fed Governor Betsy Duke there. A closer look here at the economic data that we got this morning and the prelude to a big Fed decision, and more importantly, a big Fed press conference 1 week from today. Meanwhile, we turn back to markets. They are deep in the red, though off the lows of the day, but no real recovery right now for some of the trucking stocks. Most of them falling today. This after an announcement of some prime competition coming from Amazon. That's coming up in our Stock of the Hour. Up next, right here on Bloomberg. All right, time now for our Stock of the Hour. Taking a look at trucking companies, particularly those in the less than truckload space, all moving lower on the back of news that Amazon is expanding into that space. Joining us right now to talk a little bit more about what this could mean is Bloomberg TV markets correspondent Nora Melinda. Now, just to set the tone here, I mean, Amazon announced a month ago they were kind of creating this sort of a arm of their logistics businesses, the idea that they would go deeper into this market. We got the news today that basically we're talking about less than truckload, which is basically exactly what it sounds like. Instead of a full truck, it's a less truck. But this is kind of a business that was largely left to companies like Old Dominion and Saia and even to a certain extent FedEx,
right.
FedEx Freight. Yeah.
Absolutely. So, I mean, as you mentioned, this is a space that's really been dominated by the companies that you called out here. But what we did hear back in May is the fact that Amazon will be stepping into the space. But what people are really reacting to is more or less the scope, the scale of it, the fact that it's nationwide.
Yeah.
Now, we know that...
Wasn't the language they use like we're going to be like every single place in the entire
essentially.
universe
So this is giving a bit more
Yeah.
of a granularity,
Yeah.
specificity to this, and people are reacting as to whether or not Amazon will actually be able to dominate the space long term.
Right. Well, that's what I'm wondering about, because the Amazon effect, no matter what industry you're talking about, is very real. But even still, I mean, you think about sort of the effort that they're taking on here. Who are they currently trying to unseat? And I mean, how difficult truly would that be?
Well, this is pretty tough. I mean, you need a number of things to make this happen. You need terminals, you need complex routing. You also have dense pickup locations that you have to configure. To your earlier point, I mean, we have seen Amazon dominate in so many different ways. We've seen a company that's been essentially a retailer now moving into the more largely logistics business where they have all these Amazon packages that come to your house. So the question here now is whether or not they're actually able to unseat some of these names like Old Dominion and FedEx, and if they're able to actually figure this out in a more complex fashion, if they're able to actually see if they can kind of come and play in the game here.
It raises a lot of questions, too. I mean, this is the margins in that business are not always very friendly, and it's a hard business to navigate. And I do wonder if there is sort of a idea that Amazon might be willing to take a loss on this in the interest of just sort of, getting its foot in there and creating whatever sort of monopolistic stronghold it can, in the same way that it did years ago when it came to e-commerce.
And that's the question. Yeah. People are like, we've seen this playbook before. How are they going to do it in this scenario? That's what you're seeing analysts on Wall Street really trying to configure in this moment as to whether or not they're actually going to have to take some sort of loss to get to the ultimate goal here. But if they are able to actually make the goal and see it through, they'd be pretty much a strong competitor in this market that's largely been dominated by names like FedEx and Old Dominion.
Now, we're sure Amazon's going to use trucks. They're not going to use those little bicycles that you see all
Let's
around
hope
New
not.
York City. Those things are a menace, by the way.
Especially when you put engines on them. They're a real safety liability.
Yeah, I agree.
know.
You have to
Gotta
watch
out for
back.
them.
Yeah. Well, Nora, great reporting as always. That is our Bloomberg TV markets correspondent, Nora Melinda. Meanwhile,
what if they just started like their own version of Uber and you can just ride in the back of one of those things?
I mean, that might work for someone. I'd rather not. Anyway, stocks are selling off. We're going to tell you why maybe next and walk through the closing bells with Erica Lau of North Growth Management next. This is The Close.
We're very constructive on the earnings cycle, and we see that, payback from some of the CapEx spending starting to flow through. So it's something we're excited about. And do think this year the level of growth we've seen from an earnings perspective, especially in the first quarter, is pretty phenomenal.
Anushka Gupta over at Goldman Sachs' Apex unit, kicking us off to the close about 50 minutes ago, talking about corporate fundamentals. But of course, the market isn't just about fundamentals. It's also about sentiment. And right now, that's sentiment being challenged.
Yeah, absolutely. And what's interesting about this sell-off is that it's pretty broad-based. It's not what we saw yesterday. You have more losers than gainers in the S&P 500 down right now, more than 300 names. So not necessarily seeing that breadth that a few folks had been pointing to as a sign of health, even amid the sell-off today. It just looks like a lot of broad-based selling here, Romaine.
A lot of broad-based selling, and you do wonder what can turn that around. We are going to get Oracle earnings after the bell. They've sort of become, I guess, in addition to NVIDIA, one of the main proxies for the AI infrastructure build-out. And I was kind of looking, I forgot, that stock actually hasn't hit a record high since September of last year.
No kidding.
Yeah, it's been under pressure a lot, despite all of the talk about it and some pretty phenomenal numbers over the last few quarters.
Yeah, certainly a sign of the times. I mean, you can have that conversation about a ton of different names that are in the conversation, but it's going to be interesting to see what Oracle actually delivers here, because certainly speculation is high.
I tell you, I'm building a data center on my balcony.
I'm so happy for you. That seems to be the move.
Yeah, I'm not sure the condo board approves, but we'll work that out when we get there. All right, let's count you down to those closing bells, just about 8 minutes away, and get some insight on those fundamentals and that sentiment. Erica Lau joins us, CEO and lead portfolio manager at North Growth Management. And Erica, we kicked off the show talking about fundamentals with Anushka, and I am curious if you could focus a little bit on to that, not so much with the quarters that just passed, but the next couple of earnings seasons where we're going to see a little bit more of what the exposure was to the war in Iran and the economic effects of that. But more importantly, also the idea that so much of what has lifted the market and the economy, at least here in the U.S., which was that AI build out, whether that has actually stood the test of time.
Yes, the last quarter, the latest quarter was phenomenal. We basically got S&P companies reporting earnings growth year over year of 29%, and that's relative to expectations of 13%. So what we're seeing is actually a very positive picture. AI CapEx spending was a big driver of the growth, but it also wasn't all of it. And Bloomberg estimates that almost half of the earnings growth, the 29%, was driven by non-AI businesses. So we are getting a broad growth in the economy, or at least in the corporate earnings side of things, including consumer companies as well. As to the AI CapEx spending, it is very early stages, and we do see that continuing, for years to come. This is a multi-year growth trend, and this is just the very beginning that we're seeing. So from the fundamentals perspective, earnings, we do expect that to continue this year, and we are seeing analysts lifting estimates for the year.
On the AI story and that growth trend, I don't think anyone doubts, at least most people don't doubt, the long-term sort of structural shifts that AI is creating for the markets and the economy. I guess there is, though, a larger question about how it's been priced into this market and whether too much of the upside has been priced in maybe too soon.
At North Growth, we take a very long-term view, so a minimum 5-year horizon. And it is true that there has been a lot priced in. So some of the pullback that we're seeing is actually healthy. We're really looking at stocks that are back to where they were a month ago or 2 months ago. And so on the short term, yes, there could be some vulnerability to pullback. But in the fundamentals perspective, what we are seeing is that we've got a long runway of spending to come.
Well, let's marry that logic into, some individual names that you are looking at, because you highlight Sienna Corp in the notes that you sent over to our producers. And that's an interesting one because you take a look at their longer term chart here, their 1-year chart, and certainly what a run up. But in the past week or so, absolutely being punished. And it sounds like working that into your methodology, that's sort of what you're on the lookout here for.
Exactly. The fundamentals have not deteriorated. The stock has had a pullback after reporting a very strong quarter and actually lifting their guidance. Sienna is a leader in high-speed optical connectivity, and they are the beneficiary of accelerating bandwidth demand. So this AI data center opportunity is major for Sienna, and it happens across 3 connectivity layers. So the first one is scaling across, and this builds on Sienna's foundational business of really focusing on wide area network connections. And so scaling across would be data centers talking to other data centers. So interconnecting distributed AI training sites across long distances. That's one connectivity. But also now within the data center, there is opportunity, there is a shift being happening in that more optical is being used in the data center.
Right.
So Sienna could also benefit from scaling out, which is connecting different racks within the data center. They have technology for that. And even within an individual rack in the data center, which is known as scaling up, Sienna acquired Nubis Communications last year, and that gives them solutions to also participate more with the structural change that is happening within the data center.
And Erica, we only have about a minute left, but when you're doing due diligence on individual names, I wonder how you separate hype from reality, because you mentioned data centers, for example. It's the buzz phrase in this market. Romain is building one on his fire escape. So how do you make sure that you're investing in a company that actually is able to walk the walk?
Well, we do. These are companies that we followed for quite some time. Sienna was a company that we initiated into our fund in 2017. And the AI gives them another avenue of growth. But even without AI, there is the need for data centers. We are consuming more data. And Sienna really is a leader in that connectivity, the high-speed optical connectivity, which is crucial as bandwidth demand keeps accelerating.
All right, Erica. Erica Lau, CEO and lead portfolio manager over at North Growth Management. As we count you down to the closing bell, it's just about 2.5 minutes to go off the session lows, Kitty Greifeld, but a 1.5% drop right now on the S&P, the NASDAQ indices, each down about 2%. Yeah,
it's interesting to just watch sentiment deteriorate throughout today because the S&P 500, in the wake of that CPI print, as expected, looked like, we were turning things around versus the overnight session. But again, we have just slipped closer and closer to session lows as we get closer to that close.
Oracle down for a 4th straight day, heading into its earnings print coming up after the bell tonight. A full breakdown of all of today's market action and a full breakdown of those Oracle earnings that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic alongside Katie Greifeld, taking you through to that closing bell with the global simulcast. Carol Massa and Tim Stenovic join us now, hopefully to bring the energy. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube on another sell-off right now in the broader U.S. equity markets.
Yeah, it feels like, here we are, those major equity averages, as you know, remain kind of hovering around the bottom. It does feel like we get a little pop.
Welcome back, Tim Stenovic, by the way.
Thank you.
Welcome back, Tim.
Yeah, thanks. I was just gone a day, but it felt like so much longer.
For us, too.
Yeah. Sorry, Carol, you were speaking.
No, that's okay. I'm used to being interrupted, but go ahead.
Oh, my turn?
Yeah, go ahead.
Oh, okay. You know, the S&P 500 today down 1.5%. It's actually down just about 4.3% from those all-time highs earlier this year. Still up almost 15% from those lows back at the end of March, Katie. But just, zooming out, this is actually a pretty big sell-off in recent days.
Yeah, it's interesting. We were just talking about it, how you think about today. We did see some of the major averages manage to turn positive, and then it was just a slow slide lower here. And it feels like it started last week when we got that disappointing forecast from Broadcom. It's going to be interesting to see if maybe Oracle can inject some enthusiasm back into this AI trade. But what a week it has been.
Yeah, but the expectations are high once again, and you feel like, okay, if we sort of get that cloud revenue forecast more, and it comes in, even if it's above estimates, if it's not sort of above estimates, then what does that do to the market? We're going to find out in just a few minutes. Those results are imminent as we get the closing bells here in New York. A Dow Jones Industrial Average selling off by almost 1,000 points on the day, down about 1.9%. The S&P down 1.6%. The NASDAQ indices down each about 2% as we wait for these numbers to settle. And the Russell 2000, the relative outperformer, it's only down 1.1%.
All right, let's go at the S&P 500, folks. We've got about 328 names losing ground on this Wednesday, 174, Katie, to the upside, one unchanged.
Let's take a look at the sector performance as well. Different picture from yesterday. You definitely had more losers than gainers. 3 sectors in the green. Leading them was consumer staples, a pretty defensive read there to see that sector in particular rallying the most by 1.7%. Energy also higher as Brent prices do march higher. Real estate also managing to squeak out a gain, but at the bottom of the pack, industrials down 3.4% and 2.5% a decline in materials.
I just want to point out the Dow Jones Industrial Average down the most, biggest one-day drop, I should say, since October of last year.
All right, guys, let's get to some of the gainers in today's session. Got to start with Cracker Barrel. A record gain intraday, highest in nearly 8 months. 1 point intraday, the stock was up as much as 35%. Here at the close, it's a gain of just shy of 23%. Logo and restaurant design scandal be gone. Instead, whimsical.
It's country ham.
I can't believe.
I know, salt and pepper shakers, Americana.
Salt and pepper shakers. Best day since 2020.
I know. How many times do you go there?
All the time.
All right.
I love crackers.
There's one in Clinton, New Jersey.
Good to know. Anyway, definitely a different song on Wall Street here for this one, a different tune when it comes to investors. Restaurant chain raised its full-year revenue guidance and said declines in store traffic are moderating. It's now up about 80% year-to-date. 27% of the float is short, though, so just keep that in mind in terms of sentiment. Hey, I got to go to what is the #1 gainer in the S&P 500, and that is Casey's General Stores. Shares rallying after the convenience store chain reported revenue for the fourth quarter that did beat the average analyst estimate. And there was one standout stat. There were a bunch of stats you could go over, but fuel revenue, $2.88 billion, up 18% year over year, easily beating the estimate on the street of $2.66 billion. That certainly helped the company out. Stock is up nearly 60% year to date. Only about 4% of the float is short. And then I just want to go real quickly to an IPO today, Parabilis Medicines. I'm hopefully saying it correct. I don't know if I am. PBLS, biopharmaceutical and clinical stage cancer drug company, raised nearly $745 million. It was an upsized IPO, pricing above its marketed range and a private placement. One existing investor, RA Capital, taking more than half of the shares in that IPO. That's according to people familiar with the matter, but that stock closing up 58%. So pretty successful IPO here.
Okay, not all IPOs good today, and I'll get to one of those a little later. Before we do that, though, I want to get to Supermicro, the worst performer in the S&P 500 by a long shot today. Fell 28%. It was the biggest drop going all the way back to March. That's the stock of Supermicro over the last couple of years, very volatile. The company announced this plan to raise $7 billion through a package of equity offerings to help pay for the production of more AI servers. Investors did not like the sound of that. The financing plan expected to dilute near-term earnings, but also signals that AI demand could lift fiscal 2027 revenue above the $50 billion consensus. Once again, Supermicro shares falling 28%.
Why is the stock in the S&P 500?
Well, it was, and then it wasn't, and then it was again.
Yeah. I know.
I don't know. I mean, you're going to have to ask the group of people who make that decision, right?
Okay.
Maybe while you're at it, you can ask them some questions about SpaceX, too.
I was going to say, I feel like we all care about index methodology more than we ever have, which is a beautiful thing.
We do. We spoke to the CEO of Wealthfront, David Fortunato, a little earlier about how, after maybe 4 or 5 days, SpaceX will be in VTI.
Yeah.
And how, they had a blog post on their website so people can include or exclude it from the portfolio. It's been a very polarizing stock, as you guys know.
We've encountered it.
Yeah, you've encountered this. Let's talk about some less than truckload companies, LTL.
You're speaking Romaine's language.
I knew that Romaine would love this story. Look at this.
I was on the phone all morning about this.
Old Dominion down 5%, FedEx Freight down 7%, Saia down 3.3%.
What does that say?
It says that Amazon is getting into their territory. Amazon announced an expansion of its own shipping service. It includes less than truckload offerings to destinations across the U.S. It's part of the Amazon supply chain services suite. Analysts have a mixed view on the impact, but there are some concerns about legacy carriers such as these taking a hit as a result of Amazon getting in their territory. I was on the highway yesterday and actually saw an Uber freight truck, which is not something that you see every day. All right, we got Oracle shares, or Oracle headlines crossing. Romaine, take it away.
That's right. Oracle just crossing the wire right now in the fourth quarter. The company says that we'll start with the revenue number. Overall revenue, $19.18 billion. That's slightly above the average of street estimates. They were looking for about 19.09. Software revenue at 6.82. That's a slight miss. The street was looking for 6.88. Operating income as well as operating margin just a smidge above expectations. The bottom line a little bit better, $2.11 a share in the most recent quarter. The street was looking for $1.97, so a beat on that number. I'm trying to suss out the cloud revenue here, but it does look like they beat on most of the metrics. Service revenue up 13%, hardware revenue up about 9% as well. Not seeing any guidance just yet that jumps out, but you see the knee-jerk reaction to the downside with the shares.
Absolutely. Also taking a look at free cash flow here, certainly a metric that has been in focus for Oracle. Free cash flow was negative $23.7 billion for the fiscal year 2026. We know that Oracle has been, trying to shift the business a little bit here, trying to support its cloud infrastructure business. As a result, that has meant that they've been burning free cash flow.
Those cloud infrastructure numbers now crossing the wire. Revenue was $5.79 billion. The street was looking for $5.72 billion. And this gets back to the question about high expectations. A modest beat, but obviously not enough. Yeah,
and the total cloud revenue, $9.9 billion, up 47% in USD. That's a quarter. I'm just looking at the press release here. Quarterly revenues increasing 21%. In terms of commentary, we're really going to have to wait till we get on the call and hear from executives at the company. But you got that cloud infrastructure revenue up $5.8 billion, up 92% in constant currency, and up 93% in dollars. Fourth quarter cloud apps, so that's the SaaS revenue, $4.1 billion. That's up 10%. But I want to keep harping on this idea of high expectations. You said 90% growth, which by any other measure. But also when you look at this earnings release, at least the narrative that they give out, you see the word record over and over again. Record performance obligations, record earnings, record revenues, record cloud revenues, record EPS, record this. I can go on. But that's just not it.
Well,
that's just not enough.
Stock down 8% in the after hours.
Down 8% in the after hours. It's up about 5.6% year to date. It's up 50% since the low in early February. So you've got to kind of think about what investor expectations were going into this, and maybe, like you say, record numbers, significant, but maybe just not enough.
But they're down. Carol Masser?
Fortunately, Anurag is joining us in just a minute.
Down now.
Down from their high. Down, 10, 11, 12% from that record high, which was all the way back in September.
But
this has been an underperformer.
But what I'm saying is that they've rallied since the low in February. So they've had a bit of a bounce back.
Yeah, okay.
I'm just saying that going into this. So, if you go back even further, there's a lot of perspective. But in the recent tone, it's been a little bit higher.
Okay, can we argue about this later?
Yeah, lovely. Right. Yeah, no, I'll be out the door.
I'll be waiting for you.
Yeah, right at 5:01, she'll be over at your desk ready to talk about Oracle. I can tell you that.
All right, guys, that is a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We do call it The Close. Closing bell. Of course, on The Close, Romaine and Katie continuing there over on TV. Tim and I right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
We're keeping an eye on those earnings out of Oracle. Just want to bring you to your attention right now the forecast coming in for the first quarter, the current quarter that we're in, looking at total revenue increase of 27 to 29% here on a constant currency basis. We're going to dive a little bit deeper into that when we come back after the break, right here on Bloomberg. We are keeping an eye on shares of Oracle down in the after hours trade. The company just reported its fiscal fourth quarter numbers, more or less in line with estimates, give or take just a bit. But we're now starting to get a little bit more clarity on their forecast, Katie. For the current quarter, the company is expecting revenue growth of 27 to 29%, EPS growth of 17 to 20%. And these numbers are slightly above estimates. They say adjusted first quarter EPS will be about 172 to 176. The street was looking for 169. The company also confirming its prior revenue guidance of $90 billion for full year 2026. We'll have to double check that number, actually. I'll just scratch that one here. But a lot of numbers are crossing the wire right now, and you see the back and forth here in the shares.
Absolutely. Traders trying to decide what to do, how to feel about some of the figures that we're getting. Oracle also saying its fourth quarter remaining performance obligations total about $638 billion. That compares to the year-over-year number of $138 billion. The big question for Oracle, of course, is how quickly they can convert that into actual revenue.
Absolutely. And it gets to this idea, too, of high expectations. I know we talked a lot about the stock sort of being well off of its all-time high set back in September. But as Carol Massar was pointing out, you had seen a little bit of a pop in the shares off of some of the more recent lows, let's just say the year-to-date lows, maybe some optimism that they were getting maybe a little bit more of an upside. The numbers are phenomenal by any stretch of the imagination in terms of percentage growth. But again, people are just looking for so much more than that.
Absolutely, and that's a story that you can extrapolate out to all of AI infrastructure at this moment. We know that Oracle is reporting into a very jittery market, and it might explain some of the agita that we're seeing in shares after hours now lower again, but certainly off the session lows that we saw, shares dropping 8% immediately after these figures came out.
Absolutely. Let's get some insights here out of Rishi Jaluria, Managing Director covering software equity research over at RBC Capital. Rishi, it's hard to really know what to make of these numbers here. Give me your first impression overall as to what you saw in the most recent quarter and also what you make of the guidance.
Yeah, absolutely. Look, I think you hit the nail on the head. These are by any stretch objectively really strong numbers. If we look at the RPO, we look at the OCI growth. But when you've had a 50% bounce off the bottoms and there's jitteriness, not just around the AI trade, but how Oracle will pay for them, around the certainty of some of the future numbers, and importantly around CapEx. And we don't have a CapEx guide yet. We're waiting for the call, but we've obviously seen component price inflation. You know, all the other hyperscalers have talked about that. Memory prices have gone through the roof, and you've seen that show up in the hardware trade. I think that's why you're seeing this crazy amount of volatility in the aftermarket, and it might require until we get the actual call and a little bit more granularity to get more comfort around exactly the trajectory from here. Yeah, good point. And I just want to just reiterate, too, for the guidance for the current quarter that we're in, and I'm just going to cite the cloud revenue numbers, which is what everyone's focused on. They are expected to grow 57%, yes, 57% is the number here. And I just want to just kind of draw your attention, Rishi, to just general idea of just sort of the sustainability of some of the growth rates. The idea that this AI build out, at least if you believe certain folks on the street, is still in its relative infancy. Is Oracle, if that is true, is Oracle still the primary beneficiary of that long term? Yeah, look, I don't know if I would say necessarily primary beneficiary, but I would say definitely most levered to that, right? And you know, especially to OpenAI in this case. And obviously there's a lot of competition between them and Anthropic. But I think the view is that there's just more leverage. If we were to say how much incremental business from Oracle or OCI specifically is coming from AI, it's meaningfully higher than if you were to say that same percentage for Microsoft Azure or Amazon Web Services. And to a certain extent, Oracle's almost become, as a stock, a little bit of a proxy for that AI infrastructure and AI build-out trade. So I think that's kind of the way that we would view that.
Well, let's talk a little bit more about that, because, you know, I wonder how much concern you have around concentration risk. You think about the OpenAI relationship, OpenAI and Anthropic in a little bit of an arms race here. And I mean, how much of a concern is that for a company like Oracle, that customer concentration, that reliance?
Yeah, it's a huge deal, right? And I think it hits its point in 2 ways. Number one is, well, maybe OpenAI was viewed as the hands down leader, when they first signed this deal. And, obviously the perceptions have shifted. Now OpenAI is making a big comeback with GPT 5.5 and Codex gaining share. But the viewpoint in the market is still, Anthropic is ahead of them. Not my opinion, just saying what I'm hearing, at least from the market. And then I think for Oracle, there is also the worry of what do the margins on this look like? If you're signing such a big deal with one customer, what sort of concessions, what sort of pricing, if you think about all the hardware being put out here, are the incremental margins good enough, or is this going to hurt what has been a very, very profitable company? Still a lot of unanswered questions here.
Absolutely. Take a look at shares right now, down about 2% or so. We're also counting down to their conference call. And at this juncture, as you said, there's a lot of questions out there. What are you most interested to hear from management at this point?
I think really 2 things. Number one is I really want to hear about kind of their diversification strategy for OCI, especially for AI infrastructure, as everyone is facing compute shortages, and Oracle's in good place and obviously has GPU allocation. But then alongside that, I definitely want to hear about color around their CapEx, right? We've seen the component price inflation. We've seen the fact that the top hyperscalers right now are spending the equivalent of the GDP of Sweden on hardware, and that's just in calendar year 26, and that number could inch higher. So I think, it's a tough balancing act, but looking for both of those here.
And I mean, they're saying basically they don't plan to issue any more debt in the current calendar year of 2026. But when we talk about the needs, and this really goes just beyond Oracle, but the financing needs to continue this build out, Rishi, I mean, what makes you comfortable as an analyst as to where that money comes from? The debt markets, equity markets, convertibles, cash off the balance sheet, where?
Yeah, look, I think it's going to be a mix of all of the above, right? They have the debt, looking at special vehicles. They have talked about equity issuance, and you've seen others in the space, hyperscalers, issue equity in order to pay for future CapEx. So I think it's going to be a mix of all of these, maybe special purpose vehicles. I would also point out Oracle's trying to find efficiencies within the organization. They announced a pretty big layoff not too long ago, and I think that frees up capital. So really a combination of all of the above.
All right, Rishi, really appreciate your analysis here as we parse through these Oracle numbers. That is Rishi Jaluria. He is Managing Director covering software equity research over at RBC Capital Markets. Of course, Oracle reporting quarterly CapEx figures higher than estimates here, raising investors concerned about profitability, even though, as we've been pointing out, I mean, you take a look at these numbers, the different records that they've been reporting, and even though we are talking about some pretty stunning figures, doesn't quite seem to meet the bar that maybe investors had been expecting.
Yeah, and this kind of puts the conference call way more in focus. And, I just want to apologize to our viewers. We were kind of stammering, studying. I mean, this release is kind of all over the map, just to put it mildly here. So trying to get sort of not only what the numbers are, but a good comp as to sort of what they were supposed to be here. So I think management's going to have a lot of explaining to do on the conference call about the sustainability of this growth, where that growth is coming from, and more importantly, just how to manage street expectations.
Absolutely. Yeah, it's going to be interesting to hear what the sell side has to ask them. You also read out this headline, and I do think it's interesting that Oracle doesn't expect to issue more debt in calendar 2026. We've seen a lot of their peers, of course, hit the primary markets for debt raising, but Oracle appears at least to plan to sit it out for now. Coming up, we're going to stick with those Oracle results and talk to Sarah Kunst of Cleo Capital. She joins us next. This is The Close on Bloomberg. Keeping an eye on shares of Oracle slipping after hours following results from the software company. Let's get into it with Sarah Kunst. She is founder and managing director over at Cleo Capital. She joins us now. Sarah, great to have you with us. You take a look at the reaction here, decidedly negative, even though we heard that sales when it comes to their infrastructure business gained about 93%. And you heard the company report a number of record metrics here. I am curious what you make of these figures and how they stack up against the expectations.
I think the expectations were for them to sort of pull a rabbit out of a hat that is not there. I don't think these are terrible results so far. We'll see in the overnight and into tomorrow. But I think the reality is that this is a company that the 5-year, when you pull back, it's been a huge ramp up. The 1 year has been pretty muted. This is a company that people got excited about for a while with AI, but the bloom has sort of been off the rose. And I'm not shocked to see people wanting to see real numbers, and then when they're not thrilled with the results, they're selling a bit.
And I do wonder, this is something we were just talking about with Rishi Jaluria as well. I mean, how much that could come down to shifting sentiment when it comes to OpenAI. We know that, they have this very close relationship with OpenAI, which is in an arms race of sorts with Anthropic. And certainly recent reporting might suggest that Anthropic has a little bit of a lead here. I mean, do you think that's a fair argument to make?
Yeah, I think that OpenAI has been sort of besieged by all sides, and it makes sense that the companies that have grown on the backs of OpenAI's success would also start to kind of diminish in this moment as people realize that OpenAI may not be the winner, that Anthropic and Alphabet are sort of claiming that throne with a lot more authority. And so I'm not shocked to see that sort of wane. I also think Oracle just has a lot on their plate. They have a lot of different businesses. They have a CEO who is very distracted, with his other sort of side quest in the media business. And so I'm not shocked to see that people just aren't that excited about this name right now.
Well, I am curious, about what names people are getting excited about. And let's just exclude the big one that we know everyone's going to be excited about in about 24 to 48 hours. But there's also a lot of other companies underneath the surface, both potentially going public and even a couple that are in the public space. Sarah, has the AI trade effectively already evolved and moved on?
I think it has a bit. I maintain my excitement about names that I think are still a little bit overlooked, like Alphabet, which is doing a lot of what we want from the Oracles, from the OpenAIs, from the Anthropics, and from the SpaceXs, and even from the Teslas, all under one hood at a much lower kind of relative valuation. And so there are names like that. I think that people are starting to look further afield and wonder what else is in the private markets as these investors get liquidity in these IPOs in the next couple months from that sort of dark trinity. We will see that money almost immediately go back to work in the private market. And I think where they're going to put their bets is going to be a next gen of AI that's a little bit more targeted and not burning quite so much money. And the less money that you burn in data centers, the less great that is for Oracle.
I am curious, and I know you focus a lot more on the VC space and the public markets, but and I hate to put you on the spot, but when you look at SpaceX coming to market, which is pretty much positioning itself as an AI company rather than a space launch Starlink company, would you buy into that?
No. I mean, the reality is that if they were going to figure out AI, I think they would have done it by now. They have access to great engineers, many of whom have left. They have access to the technology, to the models, and there's not really much there. You have Elon's word to go on. And if you run that back over the last 10, 15 years in his other companies, Elon's word means that it is coming 10 years, 5 years later than what he says at best, and often at a much sort of less lucrative stance than what he has said. And so, no, I think that SpaceX is kind of the ultimate bag holding experiment. And it's unfortunate that a lot of these public companies and these indexes are going to be the ones who are sort of forced buyers.
Sarah, always appreciate your candor. Sarah Kunst, founder and managing director over at Cleo Capital. And of course, we are expected to get the pricing for the SpaceX IPO as soon as tomorrow afternoon with the start of trading on Friday. We're also expecting maybe in the next few weeks to maybe hear from Anthropic in the public space, and maybe in a few months, OpenAI. It's a red hot IPO market. We're going to catch up with Eddie Best, the co-chair of the capital markets practice over at Willkie Farr, coming up after the break right here on Bloomberg. A moment of truth for the IPO market. Tomorrow, a moment of truth, quite frankly, for the secondary market. SpaceX expected to price and start trading on Friday. The firm attracting demand for more than 4 times the available shares, according to people familiar with the matter that Bloomberg reporters have spoken to. Joining us here in Studio 2 is Edward Best, co-chair of the capital markets practice at Willkie, Farr, and Gallagher. Eddie, great to have you here.
Thank you.
You know, I don't think it's an overstatement to say this is going to be a big test for the market. $1 trillion IPO, potentially followed by maybe 2 other $1 trillion IPOs in the weeks and months to come. Is there a sense here that the market has enough liquidity and, more importantly, enough appetite to absorb it?
I think so. Remember, first of all, SpaceX is supposed to price this week, and Anthropic was reported to have confidentially filed just a couple of weeks ago, OpenAI last week, so they're probably not going to come out until September, October. So that's going to give us the rest of the summer for the market to absorb SpaceX. And, you know, the market is huge, and as I was talking to somebody today, even with a $1.5 to $2 trillion market cap, it's still only going to be about the 7th or 8th largest company in the U.S. And so it'll be big, but it's not going to take up, you know, everything. So I think there's going to be plenty of liquidity in the market. I think people are going to be very excited about those as well. And some people may be holding on to some of their cash, waiting for the other 2 as well.
I am curious about just, you know, the way that this was pitched. I mean, obviously, we don't know exactly, just based on reporting. But we've heard a lot of what's been going on in the roadshow, the idea of this company kind of pitching a cleaner balance sheet than maybe what some people thought. And more importantly, this sort of addressable market. And I am curious that when you have a company that, let's just face it, it's probably a little bit hard to value. How do you value that as a secondary market investor coming into this?
That's a great question, and there are lots of institutional investors out there right now trying to figure that out. Also remember that it's got 3 different businesses in it. So you've got the space business, you've got the Starlink business, and you've got the XAI business, and each of those have their different fundamentals. So put them all together, and it just makes it that much harder to value. And then there's also the issue of comps, and you don't have anybody that's a true comp to this company. So it's going to be very difficult, and you don't really look at a company for its past performance. You look at what you expect the performance to be, and so a lot of this is where we think it's going to go.
Does the lack of comps, doesn't that to a certain extent work to SpaceX's advantage? Because at least they can throw any number out there and, oh, we got a total addressable market of $1 gazillion. I mean, how do I know?
You're absolutely right. Now, they can't just throw any number out because obviously this went through the SEC. They looked at it. The SEC doesn't do due diligence, but they do look at it and ask questions. So the lawyers that are involved, the bankers, are going to make sure that there is a reason, there's reasonable backup for all the statements that they made. But you're absolutely right that it's a tough thing to be able to say, it's a $1 trillion market, it's a $10 trillion market, it's a $50 trillion market. Nobody really knows.
Yeah, absolutely. When you're talking about, you know, 1 million data centers in space, certainly uncharted territory here. But I want to talk a little bit more about the roadshow, because you point out in your notes that the roadshow only began last Thursday. It's ending tonight here. So it's a pretty quick window here. And I wonder, you know, is that a trend that we're seeing, or is that something, that short roadshow, something that's unique to SpaceX?
So it's certainly shorter than a typical roadshow for an IPO. Now remember that in the last couple of years, the SEC has blessed a procedure called testing the waters. So before they even had their public filing, they went out and did a roadshow with institutional investors. So they did an awful lot of the marketing before this even became public. And so they had a pretty good sense of what was going on. So they've really met most of those investors. So this is now just picking up some of those other investors, being able to answer more of those questions, and certainly helping with the retail now. So I don't think you're going to see a lot of companies doing this, but certainly it has gotten shorter with the new testing the waters procedure.
And I do also want to talk a little bit more about OpenAI, because we got their filing actually just in the last couple of days. I thought it was last week, because time is fake at this point. But it was interesting to hear from the company saying that we have not decided on timing yet. It may be a while, because there are things we want to do that are likely easier as a private company. But basically, they looked at the trade-offs, and now they have the option to go public sooner if that ends up being the best course for them. I thought that was really interesting, surprisingly candid, and I do wonder what you make of it. The fact that, you know, private forever was sort of the mantra for a couple of years here, but now you have companies basically at least wanting to give themselves the option that they could go public if they need to.
I think that it's in this environment, when you see the expected capex for some of these companies, there's some estimates between OpenAI and Anthropic, and then certainly some of the other hyperscalers, that we're talking about over $1 trillion over the next few years. That's a massive amount of money, and even though the private markets are really huge, they're going to have to tap the public markets at some point. If SpaceX comes out well and Anthropic comes out well, OpenAI may very well say, this is a great time. I don't know what 6 months from now is going to be, or a year or 2 years. If I've got a hot market, I'll better get out there so that I at least have the option to do future financings in the public market.
I certainly understand it from the company's perspective as to why they want to take advantage of this, and you see that all the time. I am curious, though, particularly about on the debt side, and Oracle actually today in their earnings kind of talked about, at least for 2026, we're done. Who knows what 2027 holds. But is there any concern here about how that gets structured? Because some of these are off balance sheet, some of these are project financing. We can talk about this issue of comps. Some of this is being these debt sales, meaning they're being structured in a way that it's hard to really know the health of what's backing, and more importantly, the duration of what's backing that debt.
So most of the debt that was raised by folks, we talked about the hyperscalers, Apple and Amazon and Microsoft, most of those have been in the public debt markets, and those have been senior unsecured. They're investment grade rated, so that we know. It's a huge amount of money, and it's somewhat unprecedented, the amount that they've raised. There have been other kinds of financings, but I think those are much smaller. And so from that standpoint, they're investment grade. The market is looking at these as a little bit longer duration. That's really nice. The other thing that we've seen more recently is also this year they've done financings in euros, in Swiss francs. The last two deals that were done up in Canada were the largest ever done. I don't think they're spending the money in Canada. I think they're going to probably swap it back to dollars, but they're looking at all the different markets. I wouldn't be surprised if they're going to go do the markets in Asia. I joked if SpaceX does really well, maybe we're going to start seeing little green Martian, little green bonds, little green man bonds. They'll start selling bonds on Mars, because at some point they're going to need another market.
Yeah.
But they're looking at all the different markets because there's just such a huge need for all of this capital.
And really quickly, you mentioned, if SpaceX does well, what if it doesn't do well? Does that have any effect on the pipeline, a chilling effect at all?
A lot of it's going to depend on why. Mm-hmm. If it's unique to SpaceX, if it's their business, then I don't think it will. If it's not doing well and the overall market's not doing well, or if it drags down the market, then yes, it could affect an Anthropic or an OpenAI coming out. But again, there's so much excitement around this. I don't know how long that excitement's going to last, but I think the excitement's going to buoy the stock for at least some period of time.
Well, not much longer to wait.
I just love the fact that if we finally do make contact with intelligent life on other planets, the first thing we're going to actually do to them is try to sell them debt.
Yeah, and then ask if we can build a data center on their planet.
Well, we'll know how intelligent their life is and whether or not they buy the bonds.
There you go. Eddie, always fantastic to check in with you. That is Eddie Best. He is co-chair of the capital markets practice over at Willkie, Farr, and Gallagher. Meanwhile, another quick check on shares of Oracle, lower after hours, down nearly 4% as we count down to that earnings call from the company. Remember, the knee-jerk reaction was to send shares about 8% lower. You can see now down about 4%. This is The Close on Bloomberg. Well, we're less than 24 hours away from the first game of the 2026 FIFA World Cup. Global Citizen producing the first ever halftime show for the tournament, featuring Madonna, BTS, and Shakira, curated by Chris Martin of Coldplay. I'm thrilled to say that joining us live is Hugh Evans. He is the CEO of Global Citizen. Hugh, great to see you.
Great to see you, Katie.
So less than 24 hours away from kickoff, a little bit more than a month ago until, of course, that big halftime show. How is Planet going?
Planning's been great. I mean, when you're working with the likes of Chris Martin of Coldplay, who in my view is a creative genius, to produce the first ever halftime show for the World Cup final, and it's poised to be the most viewed halftime event in all of history. 13 Super Bowls in one night, bringing together the entire planet. The pressure is on, but the team is rising to the challenge.
Well, talk to us a little bit about how this came together, where the idea of the first ever halftime show for the World Cup, how that came about, and, how you are turning it into reality.
So 4 years ago, at the time of the Qatar World Cup, Chris Martin called me and he saw it and he said, wouldn't it be amazing if we could do a halftime show for the World Cup, because it is this moment that brings all of humanity together. And a few years ago, I had the honor of meeting Gianni Infantino in Switzerland. We sat down and he shared this vision. He was so passionate about it as the president of FIFA, he said he wants this to be part of his legacy. He said to me at the time, I want my presidency to be known for making a difference. So together, we established the FIFA Global Citizen Education Fund with the goal of raising $100 million for children's education by the time of the World Cup final. And I'm pleased to tell you that as of yesterday, we've raised the first $50 million. We've already starting to give away grassroots grants to education projects all over the world, including here in New York City. And this is where this idea for the halftime came about. We said if we could unite all of humanity during that moment, this would be truly special.
This is probably one of the true global events that actually lives up to its name. It is also, at least if you want to be inside the stadium, for a lot of people, inaccessible because of the cost, the most expensive World Cup ever. I know there is, in coordination with New York City, going to be a watch party in Central Park that presumably just everyday folks can actually be able to sit and watch this and enjoy it as well.
Absolutely. Earlier this week, together with Mayor Mandami and Governor Hochul and Gianni Infantino of FIFA, we announced that Global Citizen is producing the biggest watch party for the biggest event. This is going to be 50,000 people invited to the Great Lawn of Central Park. And the best thing about it, it's entirely free. So starting tomorrow morning, you can go on to globalcitizen.org/watch party, and you can register. If you're coming in for the World Cup final on July 19, you can be part of this very special moment. New Yorkers and people all around the world can be part of it.
And you're no stranger, obviously, to throwing big events in Central Park, as you have the Global Citizen Festival there every year. And we should just point out, some of the proceeds from all this, they are going to charity.
Absolutely.
Yeah.
In fact, all of the proceeds that we're through our partnership with FIFA are going. In fact, $1 from the entire World Cup is going to the FIFA Global Citizen Education Fund. So every ticket sold makes an impact.
Okay.
And so, you know, as I mentioned, just over a month ago, until this event specifically happens, that's on July 19th here. So what does the next month plus look like for you? Of course, you're no stranger to Central Park and throwing together these big events, but how are you planning on preparing for this one in particular?
So we still have a couple of big announcements coming up over the next few weeks, but our team is fully in production, working on the preparation for Central Park. We want to make this the most amazing, immersive experience for people who want to watch the World Cup final, with giant LED screens, music, sound, the opportunity for people to participate. But then on the producing of the halftime show, we have the best producers in the world working on this. We've got, Hamish Hamilton, who's called more Olympics opening ceremonies than anyone. Ben Winston, who's called, truly Guy Carrington. The best producers are all united behind this vision. And it's all going to come down to July 19, where this special moment that, in Chris Martin's view, he wants people to look down from, you talked about, aliens earlier in this segment.
We did.
He wants aliens to be able to look down and say, this is the best of humanity united as one.
Wow, that's a planet I need to invade.
Is what we really want to know.
Yeah, exactly. So. Yeah, and do they want to invest in a data center while they're at it? But I do want to talk a little bit more about Chris Martin, because this is curated by Chris Martin, the mind of Chris Martin. What does that mean? Is he going to be performing, or is he just sort of the man behind the machine here?
So he's been working incredibly hard. He actually reached out to BTS, he reached out to Madonna, he spoke with Shakira, and they worked on the creative vision for the entire halftime show together. And so he's been in the studio. I've been so in awe of the amount of energy and effort that Chris has thrown behind this. Every turn he said this is a project that he believes in, he wants to make a contribution to humanity. And the fact that we've already raised $50 million for kids' education around the world in just a few weeks is a testimony to how much love he's throwing into it. So, I mean, you're in for some big surprises. This is going to be an amazing, amazing halftime show. We, at a time when there's so much going on in the world, we want to transcend that and give people the opportunity to realize that we're all human beings, we're all in this together, and this is a moment where the whole world can unite.
Wish you the best of luck there, Hugh. Obviously a busy man. Hugh Evans, the CEO of Global Citizen, as we stick with our coverage here of the World Cup, which is officially set to kick off just about, I think, 22 hours from now, Katie Greifeld. I think we're going to hear from, was it Mexico and South Africa, the first big match there. And it's a huge week, of course, for prediction markets as well. Robinhood going live with a prediction market feature that allows users to see the bets being placed without actually logging in. Joining us right now is JB Mackenzie, Vice President and General Manager of Futures and prediction markets over at Robinhood. How you doing?
Doing great. Exciting times, to say the least.
It is exciting times. I'm assuming, I didn't check this, but this is going to be the first World Cup where we've had prediction markets in full swing, at least certainly here in the U.S. What's the demand looking like so far?
I mean, it's the largest televised event that's out there. When we think of the Super Bowl, we think about how incredible that is. Just accelerate that much higher. I think last year when you looked at the last World Cup, it was like 1.5 billion people were watching the World Cup final. So we expect demand to be incredibly strong. We see that not only people here in the United States are looking at the different types of ways they can invest in the games, but also you have 40 extra games that are occurring at the same time here in North America. So when you bring those two pieces together, you have a lot of interest from our clients and traders, and I think it's going to be a very exciting time.
I am curious. So they can obviously make a bet on the actual match itself. Can they make a bet on whether Chris Martin is going to perform as well?
Not that I'm aware of, not yet, but that'd be a heck of a one. I haven't seen him in concert yet, so I'd like to check that one off the list.
Yeah, absolutely. I do want to talk a little bit about the competitive landscape here, because especially when it comes to the NBA Finals, Telsey has made a big marketing push, and you've seen them orchestrate a number of viral moments around the Knicks in particular. And I wonder, how you sort of, get out the word about Robinhood prediction markets and compete for mind share when it comes to a lot of these hot sporting events right now.
Well, look, at Robinhood, we have 27 million plus customers already in our ecosystem. And what we're trying to do is find the right product that they want to trade. That may be a future, maybe an equity, maybe an option, and maybe prediction markets. So what we're trying to do is provide them choice. And then in doing so, what we do is we want to give them the best possible product that's available, really clear understandings of how they actually can trade it, and then most importantly, great pricing. And that's what we've really been pushing on. We altered our pricing for our customers, making it lower so it's competitive. Our gold product is amongst the lowest in the whole entire industry. And with the launch of our Rothera exchange that came through a joint venture with Susquehanna, we can actually continue to push that advantage to those end customers. So at the end of the day, customers that go through Robinhood are getting the best possible product at the best possible price for them with the best liquidity that's in the marketplace.
But give me a sense here. We said in the intro that you can do this without logging on. What's the idea? Is this client conversion? What are you trying to do with that?
Well, you can't trade without logging on, but you can actually see the prices, and you can look at where the market's going. So really, if you think about it, it's an opportunity for people to take an investigation. And what we find is a lot of investors want to look and see and get an understanding of how that market trades, feels, and then make a decision if they want to move forward.
What I'm getting at is this idea that by having a little bit more public face of this, that presumably somebody who logs on who checks who's not a Robinhood client, maybe I would assume you want them to become a Robinhood client?
I'd like to have everybody become a Robinhood client.
Yeah, all right.
Well, that gets at what I was wondering about. You mentioned that when it comes to your prediction markets, you already have, a built-in customer base there for Robinhood proper. And so when it comes to prediction markets, what are you seeing there? Is it mostly folks who are already associated with Robinhood, who have Robinhood accounts for more traditional asset classes, or, are you expanding the buy here and bringing in new clients?
It's actually a nice combination. What we're finding is new customers that want to come to the marketplace are able to do so because prediction markets is something they're interested about, and they know that Robinhood is going to give them a great technology experience as well as great pricing. But customers already in the ecosystem are now using it. In many cases, they use it for price discovery or understanding something outside of sports. One of the most highly traded products from a volume standpoint is the 15-minute Bitcoin price contract. And what we're seeing is people who actually are interested in participating but maybe aren't sure if they want to go and buy a Bitcoin or not, they can actually trade on the price because they have an opinion. If their opinion is that it's going to go up or it's going to go down, prediction markets gives you that capability to go do so. Same thing with elections. Obviously, we have had a lot of election coverage. Take the Los Angeles mayoral event. You've had a lot of people who came in, started looking at those products, said, hey, this is something that's interesting to me. They may or may not trade it, but then they'll realize the ecosystem is much larger than just, sports and politics.
I do have to ask you, though. I mean, we had headlines earlier today that the CFTC was looking to maybe provide some more guardrails, particularly when it comes to prediction market bets on war and elections. Is that something that you guys have talked about internally, how you might manage that, particularly given that we are A, in the middle of a war, and B, in the middle of an election season?
Well, first of all, that rule has already been in place. I think what the CFTC is really trying to do is add clarity as to what does that mean, because sometimes there are some fringe examples that have occurred with other exchanges that have caused issues, questions of insider trading or market manipulation. And so from Robinhood, we are held at a higher standard. We're what's called a futures commission merchant. And what that means is that we have to know the occupation of that trader when they open up. So we know where you are. If you are part of the Department of Defense, we'll flag you before you can place that trade. trade. So I think what the CFTC is doing is trying to build better rules that we can then utilize and make a better marketplace for.
And we kind of heard from Telsey saying that they might actually finally start to verify the jobs of the people for certain types of bets. But you basically, by the nature of what Robinhood is, you're already required to do that.
We do that for every single customer that comes through the door, and we're required to hold that. We think that's where that should be the bar that every single exchange and every single prediction market is held to.
All right, JB, got to leave it there. Really appreciate it. JB Mackenzie, Vice President and General Manager of Futures and Prediction Markets at Robinhood Markets, which I think he's going to be busy. Not only the World Cup, you know there's a Knicks game tonight, Katie.
I keep hearing about that.
Are you going to be courtside? Is Mike taking you this time?
I don't think so, and it looks like a dangerous place to be right up on the action there.
Yeah,
so.
you got to be careful. You never know when some 7-foot guy is going to fall into your lap.
True.
We're going to set you up for what to watch when we come back after the break. This is Bloomberg. All right, a busy day for markets. It could get busier tomorrow. A lot to watch over the next 24 hours, including a rate decision from the ECB.
Absolutely. We're going to get that at about 8:15. And then back in the U.S., 8:30 a.m., we're going to get jobless claims as well as PPI.
All right, but the real action is really going to come after the bell tomorrow. We're going to get earnings out of Adobe and out of Lennar, but we're also expected to get pricing on the largest IPO in history.
Absolutely. I think that is the event that most folks are going to be keeping their eyeballs peeled for, that pricing for SpaceX ahead of the first trades that we'll get on Friday. We also get the FIFA World Cup kickoff, and we'll also know what exactly the Knicks were able to deliver tonight.
Absolutely. We'll see how Knicks fans behave themselves overnight, if you will. Katie, I'm talking to you there.
Okay.
Be careful. All right, that does it for us. Balance of Power is up next, right here on Bloomberg.